Oops. Fan off.
Okay, just letting you know that it's live stream on YouTube as well.
Okay.
So if someone can't access it for some reason, they can always fall back to the YouTube just in case. Um, wait for 1 more minute or 2 more minutes, Teddy.
Yep.
All right. Okay, I got 45 people online. Do you want to start now, Teddy?
Okay, yeah, we'll do
Or do
that.
you want to wait for 2 more minutes?
We can bring them in and then
Yeah,
we'll,
okay.
we'll
I'll
see
start
if
now. Okay.
yeah.
Recording. Okay, you want to carry on with the formalities?
Okay, all right, so I'll get started. Hang on, my computer is a bit laggy. Okay, good afternoon and welcome to CP Australia City Taxation Discussion Group for our final online meeting in 2025. I would like to begin by acknowledging the traditional owners of the land on which we meet today. I would also like to pay my respects to the elders past, present and emerging. For those who don't know me, my name is Teddy Kosasi and I am one of the conveners for City Taxation Discussion Group for CP Australia. Alongside Henry Kwok, we put together a session every second Monday of the month for all professionals. So it doesn't matter what professional bodies you belong to, you're more than welcome to come, to share, to learn, and to exchange your knowledge and expertise in your professional field. The purpose of CP Australia Discussion Group is to provide a forum for like-minded members to exchange information and share knowledge on topics of common professional interest. CPD hours can be claimed for discussion group sessions with appropriate professional content. We believe that our discussion group is here to serve people and solve problems, and also to support members, support professionals, support businesses, and support community, because we believe together we can make a difference. Just a few housekeeping. If you have any question, please raise them in the chat box. And if we were unable to address all the questions during this webinar, we'll take them offline to the speaker. The webinar and all chat history are being recorded, and subject to the consent of the speaker, we may publish the recording and relevant presentation material via our email systems in the next few days. For anyone attending via telephone audio dial-in, if you can email us your name and the phone number you used to dial in so we can record your attendance as well. So thank you for your support, and please let us know if you have any feedback via our email, which is members@citytaxation.com.au. Also, I would like to remind you that if you're on social media, please hashtag CP Australia, hashtag City Taxation, hashtag Together We Make a Difference, and share any insight that you think relevant and will benefit other members. So this afternoon, we are privileged to welcome Shelley Benton, Director at Super Clarity. Shelley is an SMSF specialist advisor and auditor with more than 2 decades of experience in superannuation, compliance, and risk management. Before founding Super Clarity, she spent 8 years as head of technical at ASF Audits, providing strategic guidance and high-level technical support to SMSF professionals across Australia. As Director of Super Clarity, Shelley helped practitioners navigate complex legislation, resolve compliance challenges, and manage risk with confidence. She delivers practical compliance solutions, risk management strategies, and technical education designed to empower SMSF professionals. A respected industry voice, Shelley is a sought-after speaker and commentator recognized for her clear, pragmatic insight that cut through complexity. So please welcome Shelley Benton from Super Clarity.
Thank you, Teddy, and good afternoon, everybody. Thank you for joining us today, and thanks to the City Taxation Discussion Group for the invitation to speak to you this afternoon. So I guess the question we want to kick off is what is the new super era we're talking about, and why do market valuations matter? And the reason, of course, is, drumroll, Div 296. And I hope we've finally seen that Div 296 roller coaster come to a bit of a standstill with taxing unrealised gains thrown out of the carriage, which means we now have new draft Div 296 regime in place, and we need to consider how that's going to affect market valuations. And it essentially means for us that it shifts and places a greater emphasis on accurate and timely market valuations. So there's going to be more checking that realised gains are properly measured and reported, and that's going to become increasingly important for funds approaching or exceeding those new balance thresholds. For those funds in particular, there'll be a bigger focus on having a much better and robust valuation process, and also the documentation that has to be in place to support the market value of the fund's assets and to also meet their compliance obligations. Before we get started, I have a little bit of housekeeping. I'm not licensed to provide financial or legal advice. This session is for compliance purposes only. And as I always say, just be a sponge, absorb everything, squeeze out what you don't need, and then just use what you like. And if all else fails, seek professional advice. As Teddy said, very happy to take questions along the way, so please don't hesitate to put them into the chat box and I'll do my best to answer them. Otherwise, we will get back to you after the session if you leave your details. So let's get started. Now, under the new draft regime, the tax on super will apply to income and realised gains on 2 thresholds. Firstly, at a rate of up to 30% on the proportion of the members' total super balances between 3 and 10 million. And secondly, 40% on the proportional balances over 10 million. And the way those numbers work is it's the normal 15% up to 3 mil, then there's an additional 15% between 3 and 10 mil, with a further 10% over that 10 million mark, which is how we get to the 30 and 40% percentages. So it will be indexed in line with CPI, and it will go up in jumps of 150,000 and 500,000 for each of those thresholds, which is a big difference to what we've seen with the previous draft legislation that we were looking at. So effectively, the government's philosophy of taxing members with those higher total super balances still remain in place, but at least now it applies to realised gains and not those paper gains that we still had in place about a month ago. We're expecting the legislation to be out just before Christmas this year, and while there will be a consultation period, if you blink, you're going to miss it, because that's how the government's working these days. There's very short consultation periods for even the most dramatic changes we're seeing to superannuation law. We know that if it gets passed, it will start from the 1st of July 2026, with the operative date being the 30th of June 2027. So unless you've got more than 3 mil in your fund on the 30th of June 2027 as a member, Div 296 won't apply. The good news is that it does align more suitably with the Treasury's recommendations to implement it across the industry on a more orderly and timely basis, because if you remember before, we were way past 30th of June 2025 and we still didn't have any clarity on whether that legislation was going to be passed or not, which meant we would have had to have backdated to 30th of June this year had that come through. But luckily, we've got a much more orderly and timely basis that we're looking at, and it's going to give those who are affected by this new tax regime a little bit more breathing space to just work out what their strategies are going to be. Now, we're not here to discuss Div 296 as such in this session, but how it impacts market valuations, because between the SIS rules, the auditing standards, and the ATO's valuation guidelines, there's a lot we need to unpack. So the question is, does Reg 8.02b, all about market valuations, really care about Div 296? And one of the more interesting aspects of the amended Div 296 legislation is that the market value rules under the SIS are seemingly very indifferent. They don't even know they exist. And even more importantly, they're not even going to impact it whatsoever. The only thing that's going to impact it is the SMSF trustees, who understand the impact of Div 296 on their hip pockets. And they'll be very aware of how market valuations can mean the difference between being subject to that tax or not, depending on their circumstances. So let's go through the requirements of Reg 8.02b so that we can all have an equal footing and an understanding of what the meaning of the SIS regulation is and how it also applies. Now, Reg 8.02b is very simple. It says that assets must be valued at market value when preparing accounts for the end of each year of income. And if trustees are a little bit confused about what preparing accounts means that's why we've got section 35b, which requires trustees to prepare, amongst other things, a statement of financial position for each year of income in line with those regulations. So it means that trustees can't just get a little bit cute and write anything down in terms of preparing accounts. Now, we know that super funds aren't reporting entities and they need to prepare financial statements in line with what the trust deed says. Now, where the deed's silent, they could prepare those special purpose accounts subject to professional standards of the accountant and the auditor, which means under those special purpose accounts, those financials are simpler, less expensive, and it also minimises the amount of information in them. But where the deed stipulated that the fund had to prepare general purpose accounts, then they had to be prepared in line with Australian accounting standards. So it always is beneficial to read that deed, read the deed, as we've heard many times before. So it's true to say in this particular case that some assets are going to be easier to value than others. So if we've got listed shares, for example, they have a ready market which is available that you can find the price on the ASX at any time. Other assets, a little bit more difficult to value, such as unlisted entities, and of course, our old favourite business real property. So we'll be drilling down to these a little bit later on, but what does it mean for trustees? Where there's not a ready market, do they have then more flexibility on how they can value their assets in their fund? Can they pick a price point that best suits themselves? So can they cherry pick, especially if there's a range they can choose from? Like, are they expected to pick the highest, the lowest, or the in-between? Well, the short answer is no, because we need to look at the definition of market value to see what the requirements are and also what the expectations of the ATR from the trustees. Now, to do that, we need to have a look at the definition of market value in section 10.1 of SIS. And what that says is the market valuation of an asset, and to avoid doubt here, the word asset means any form of property, which includes money, is the amount that a willing buyer could be reasonably expected to acquire the asset from a willing seller if the following assumptions were made. And there's three assumptions that we need to go through. The first one is that they both dealt with each other at arm's length, which means that there's not a fire sale, it's not being sold to a related party at either an under or overinflated price. There's no sideline sweetheart deals that are being made that's going to influence the price. And it's assumed that both parties have come together on a commercial basis, they've got an assumed knowledge of the market, and it enables them to strike a price that's equitable and fair to both of them. Secondly, and we don't really talk about this one too much, that the sale occurred after the proper marketing of the asset. So the asset just wasn't given away to the first buyer, it was actually put out to the market through proper advertising, so the seller could actually see what the demand and the appetite for that asset was and come to what a reasonable price, a market valuation price was. And lastly, both the buyer and the seller acted knowledgeably and prudentially in relation to the sale. And what that means is that both parties understood what was happening in the market for that type of asset. They understood the price that similar assets were commanding in that marketplace, and they understood the supply and demand, and they were able to determine that price that both of them could live with. So while we need to remember these are assumptions only, it's these assumptions that have to be in place when the trustees value the assets if they choose to go down the path to not obtain an independent market valuation, which means that all market valuations have to be based on a specific methodology using careful consideration and sound judgment. Now, one of the things that we're not referring to here is net market value, which takes into account disposal costs and depreciation, and it means that the market value will be understated if that definition is used. Of course, you can apply that to the total super balance, the net market value, but we're not talking about that today. I've also seen net market values being applied when calculating the in-house assets, so be very careful there because that's going to result in an artificially higher percentage. So be careful that you're using total market value in that calculation as well. That's a little aside. Now, one of the things with the SIS rules is that to be compliant, you have to be fully compliant. You can't just be a little bit compliant or almost compliant. You have to be fully compliant. So a good example here is that if you're going to sell a property, say your residential home, to an unrelated party, are you going to use a valuation that was undertaken 12 months ago? If you're going to get the best possible price in the current market, you might accept that after finding out whether that price is actually current in the market. You'd be having a look and seeing what other properties in the same area are going for. You'd be talking to real estate professionals, and you'd be making sure that you had a reasonable assumption if you're going to sell it for the best price at the current moment. And that price may be the price 12 months ago, but unless you do your due diligence and find out whether it's still or isn't, how can you accept that price and sell that asset to an unrelated party? Well, you can't. And the same logic applies to providing a market value at June 30, because while the price may be the same, unless you've done your research, how do you know? And the other thing you need to do is to document, because you need to explain that rationale to third parties, such as the ATO and to your auditor. So let's take a look at what the ATO wants and what their market valuation guidelines are. Now, firstly, valuations have to use a fair and reasonable process that basically dovetails very nicely into that definition of market valuation under section 10.1 that we just spoke about. And you can take a look at QC, excuse me, 26343, and that's one of the very few QC codes that remains intact on the ATO's website since the big refurbishment. We all love the new ATO website. Anyway, but you can have a look at that for more information, and it outlines the ATO's expectations, which basically says the valuation has to be based on objective and supportable data, which ties back to the fact that it has to be documented. And what the ATO says is that the valuation has to take into account all of the relevant factors and considerations that are likely to affect the value of that asset. So if you're going to ignore any change in the market just because it's all a little bit too hard, that's not going to be acceptable. Next, it has to be undertaken in good faith, and that it also uses a rational and reasoned process. And the last requirement is that it has to be able to be explained to the valuation in terms of the methodology and the evidence that's gathered in such a way, as we've said, that it can be explained to a third party in simple terms. Now, just because it's simple, it doesn't mean that it's fair and reasonable. So if you had a fund that owns business real property which is leased to a related party, there's a lease agreement in place, and we're talking about market value of rent here, but that lease agreement is a one-page handwritten lease agreement that just says the rent's paid monthly in arrears and that it's at market value, and both the parties are the same party, of course. Is that fair and reasonable? Could that be explained to a third party without cringing? Well, I don't think so, and it would definitely be an issue at audit. Next, we need to consider who can value assets and how assets have to be valued. So let's take a look at the who, because the valuations can be provided by a variety of people. Firstly, you can have a registered qualified valuer providing a formal independent valuation, or it can be a professional who has specific knowledge, experience and judgment, and they could be considered to be someone who's a current member or a relevant professional of a member of a professional body or a trade association with that foundational experience and as an industry leader in that area. The second thing that the ATO says is that you don't need an independent formal qualified valuation each and every year. The guide says that if you follow the ATO's guidance and guidelines, they'll generally accept the valuation when the ATO reviews the fund, and as long as the fund trustees can provide evidence of that valuation, which includes documentation of that valuation method used, well, then you're going to get a green tick from the ATO. They've also said that if the asset value is a significant proportion of the fund's value, well, the valuation might be complex or difficult, or it could be having a significant event that's occurred, then you should also consider getting an independent valuation. Now, this doesn't mean that you have to, because there's no requirement under SIS, there's no requirement under the auditing standards to consider getting an independent valuation if any of those things happen. But I guess the interpretation here is that if you're going to get the valuation wrong, especially where it's material, and the ATO then is suggesting to avoid getting it wrong, go and get an expert to do it right, and the trustees will obviously have to pay for it. They also say that if it's a complex asset, that's probably unlikely that the trustees will have access to resources to provide evidence or potentially even understand the market conditions surrounding that asset as well. And lastly, if it's a significant event, the impact on the valuation will be material. So the types of things that constitutes a material event are things like a natural disaster, market volatility, a macroeconomic event such as a major hike in interest rates, or there could be significant changes to the character of the asset because it's been undergone repair or maintenance or renovations. But as we've said, not a requirement to obtain a valuation, qualified independent valuation, and pay for it each and every year. What about the trustees? Can they value assets, and under what circumstances can they value it? Well, let's start with what they can't do. Under Reg 1318AA, when a fund is selling collectible and personal use assets to a related party, they are required to obtain a valuation from a qualified and independent valuer. Now, that's very specific, and it only applies to those assets when they're selling, because as we know, a fund can't acquire collectible and personal use assets from a related party, so it only applies to the selling. Now, there's no requirement to obtain a formal independent valuation for other assets, and trustees can value those assets outlined by the ATO. But the question here is whether a trustee who's also an independent valuer could also provide a valuation for the asset. And the answer is that they can't, because they have to be independent. The ATO has said they can't be a member or a related party of the fund, which means they can't be a relative. They have to be impartial, unbiased, and not influenced by anyone or anything when that formal valuation is undertaken. Now, it might be a little bit weird and it might be a little bit unfair, especially if the trustee or a related party is a professional valuer, but it also means that there can be a potential conflict of interest that they can't escape from if they undertake that valuation. It doesn't pass the independent smell test, and it's the same reason why SMSF auditors can't audit their own fund. And I get that the professional obligations are a little bit different, but the conflict of interest here is the same. And similar to SMSF auditors, there's really no safeguards that can be applied to reduce those threats to an acceptable level, So therefore that engagement can't be undertaken by a trustee who's also a qualified valuer under those circumstances. And of course, the most obvious one we think of here is when a fund is acquiring an asset, an allowable asset from a related party. So let's take a look at how that's going to play out in terms of the valuation options that trustees have available to them. So let's start from the initial question of whether the trustee wants to pay for an independent market valuation report. If the answer is yes, well, they get a green tick straight to audit and it's ready to go. Now, there could be a very simplistic and general overview as to how that and other evidence can get you across the line, but it is going to depend on the quality and the quantity of the evidence, and it will also depend on the auditor's professional judgment. Because if they don't want to get that qualified market valuation, how is that going to work? The trustee or their accountants, you guys, have to put the time and effort in to obtain that objective and supportable data and put together a market valuation package that the auditor is going to be happy to give the green tick to. And as we've said, who is the one who is actually going to spend the time doing that? And if it's you, how are you going to recoup that time? That's obviously a business question for your firm. But if you spend enough time and effort putting it together and it ticks all the boxes, well, then it's going to get ready to audit. If the answer is no, and nobody's willing to spend the time and effort to put it together, or if they do, it doesn't hit the mark, well, then you've got a potential Reg 8.02b issue that might be reportable to the ATO, which means that the days of trustees just putting together a very simple minute saying, I researched prices in the area on domain.com and it's the same as last year, does not exist. That is not objective and supportable data. So we need to think about it here because you've also, if you're going to have a Reg 8.02b breach, you've also possibly got a Part A qualification as well because the statement of financial position could be materially misstated. So lots to think about because the flowchart's fairly clear. Take this course of action and this is a result. And of course, as I said, this is fairly simplified. But the reason why it is now so cut and dry is that auditors aren't taking the risk of accepting questionable valuations, especially based on data that may be 12, 24 or 36 months old. So the industry is getting a very serious message that, there's no longer this honeymoon period of accepting anything for a valuation because lack of audit evidence for market valuations is one of the main reasons why SMSF auditors are referred to ASIC by the ATO, which means, of course, that the best approach is to work with your auditor. Please. It's not the auditor's job to value fund assets. It's up to the auditor to ensure that those assets are fairly stated and that they check the methodology that's used by the trustees to ensure that it's correct. And the way in which that they can do this is for the trustees to provide that objective and supportable data. Your auditors will most likely have an audit checklist. Provide that to your trustee clients so that they have an expectation of what they need to provide at each year when the audit's been undertaken, especially for those complex assets. And it also gives them a little bit of frame of reference as to what the expectations are if they then decide to buy into those complex assets, because then they've got something that they can go, okay, well, this is what I need to provide every year. As we've talked about with the auditors, under ASA 500, auditors are required to have that sufficient appropriate audit evidence on their audit files that substantiate the value of fund assets. So auditors have a double obligation, not only from the SIS regulations, but from the auditing standards to make sure they've got that documented evidence. And the rule of thumb here for auditors is that an independent party who knows nothing about the fund could come to the same conclusion as the auditor when they look through the audit file and went through all that documentation. So it's one of the reasons why it's critical for auditors to have that evidence on file. And as I said, not just a minute from a trustee stating that they've looked online, reviewed comparable sales, and the value of the property is $500,000. If that minute comes through, make sure that those comparable sales have been attached to the minute so the auditor can actually see them and come up with the same conclusion as the trustee. So here's the question though, what if you have an asset that has no ready market available? Well, we all know that investments can fail, which means there's no value or ready market for those, or you could have a value that's been significantly reduced, even down to $1. And I like to see, assets that might be in liquidation or still in administration, not written down to zero, but written down to $1, simply because it doesn't drop off the balance sheet the following year. It just depends what's happening. So we need to have and be aware of whether there's some indication of recovery through letters or documentation that's been provided, and to make sure that we're not forgetting about that asset because it's already been written off. It can't be written off until we know the outcome. When we're talking about crypto, for example, the ATO has already said if you've got an exchange, a crypto exchange that goes belly up, the trustees need to wait until administration is finalised before claiming a CGT event. Okay, let's get back on track, because how could there be no ready market or value from an asset from the first day that it's purchased into the fund? If we think about the fact that trustees are supposed to be aware of their responsibilities and obligations under the covenants and be investing in assets that support the retirement benefits for their members, well, then we need to think about, does that satisfy the sole purpose test? Because the ATO has said that it's unlikely that investing in an asset that has no known value, no potential for capital growth or income, that's unlikely to be a prudent investment. So the question is whether that type of investment would, as we've said, satisfy that sole purpose test or not. And I've got a really good example about this, because I once had a fund that invested in very specific types of environmental tanks. Didn't have a value, but it continued to be listed at cost because there was no market value for these environmental tanks. So the question was, why did the fund invest in the asset? We looked at all the facts and circumstances, and the answer was found in the invoice, because it was a buyback under a warranty from a company operated by the trustee, and obviously the company didn't have the cash to buy back those assets, which is how they ended up in the fund. And it had been listed in the fund at cost for several years. We did it the first year, and obviously that was a Section 62 breach. And apart from that, there was really no real strategy or investment rationale for the fund to own that investment, apart from the fact that the business probably couldn't afford to buy them back under that warranty period. So yes, that was a sole purpose test breach, and it's a good example of where all the facts and circumstances come into play to provide an overview of what's happening and why in the fund, and what trustees are doing and why they're doing it. And as we've said, where there's complex assets in the fund, or there's been a significant event such as a natural disaster, pandemic, or market volatility, the trustee should consider getting a qualified independent valuation according to the ATO. Okay, so what happens if an ACR, an auditor contravention report, gets lodged with the ATO? Well, we know that auditors are no longer absorbing market valuation risk, and it also means that that supposed 3-year rule, which was never a rule, is no longer being tolerated by auditors, and if they certainly shouldn't even be allowing that in the first place. The ATO already investigated some 16,000 funds back in March last year that didn't have their values changed over a 3-year period, and there was no ACR lodged. And it also sent letters out to 1,200 auditors, and these were for the more complex assets such as unlisted entities and property. Now, they were following up on those funds and auditors to make sure the valuations are current in the next financial year. And while the ATO didn't say that those valuations weren't necessarily correct, that was an anomaly that they were investigating to ensure that those funds were complying with Reg 8.02b. So the criteria for auditors to report to the ATO under the financial threshold test is either 5% of fund assets or $30,000. So there is a lot of funds that get caught up in this net, because those financial threshold tests have not been changed since 2009, but obviously we've seen a huge jump in member average balances. The ATO's also been inundated with Reg 8.02b ACRs because of all of these reasons, and they've also come out and said that at the moment it's one of their fastest growing ACRs that are being lodged, and at the moment they're seeing about 12% of all ACRs being lodged as Reg 8.02b breaches. So what are they going to do with that? Will depend. Like anything, the ATO will look at all the facts and circumstances depending on what happened, why it was reported. They will take a risk approach to reviewing these types of reported breaches. So if your client is in the high risk bracket, so they've got an incorrect market value of an asset, for example, and the asset's also an in-house asset, you might actually want to consider a voluntary disclosure, because if it's triggered Section 82 and has to be disposed of, you've got nothing to lose and everything to gain without taking that first step and engaging with the ATO through their voluntary service. A little bit counterintuitive to fall on your sword, but the anecdotal evidence is that you get a better outcome if you do that and you enter into voluntary disclosure with the ATO. When they do investigate, they'll see whether the valuation is in line with its guidelines, and if it is in line with them, well, they'll generally accept that value. As we've said before, as long as when they review the fund, the trustees can provide evidence of the valuation, which includes documentation of the valuation method that was used. And just to reiterate here again, the first thing the ATO says is that you don't need an independent qualified valuation each and every year. So the circumstances in which they'll accept the valuation is if it doesn't conflict with their valuation guidelines or their market value for valuation for tax purposes guide. You can't use different valuations for different purposes. So you can't use a low one for CGT event and a higher one for the financials, because you've got in-house assets in the fund. And the last one, recurring theme today, is that it was based on objective and supportable data, which is at the core of determining that market value. And here's the kicker. This is the actual issue that says if the ATO doesn't agree with your valuation, they will use the method that they think is appropriate and apply that to an amended value. So this is where the ATO's approach gets really real, when you start thinking about how it's going to impact NALI, transfer balance caps, the total super balance, and while we're still waiting at the gates, Div 296. Because the last thing you would want is for the ATO to determine what the market value of an asset is when the trustees are looking down the barrel of potential compliance and tax issues. Now, if the ATO, you do get to that point and the ATO does use its own methodology to value the asset, you need to check that it's correct. You need to turn the mirror on, make sure that it can be substantiated, so you're not in a situation where they've applied comparable sales for a 3-bedroom house to a 2-bedroom unit, for example, because they're going to be using their own valuation guidelines to value the assets. So you make sure that you check that they're doing that in line with their own guidelines. I can see there's a question that's come through. It's from Hal. Thank you very much. Is it acceptable to use retrospective property valuation reports? For example, a 30th of June 25 independent property valuation report on the 31st of the 8th, 2025. Unfortunately, it will depend. First time I've given that answer in this webinar, but it will depend on what the requirements of your auditors are. Some auditors will accept, within a period, a time frame before and after the 30th of June. It may be 1, 2, or 3 months. Some may accept 6 months. So you will have to go and check with your auditor. You can't obviously have a valuation report that's dated March 2025 and apply that to a 2024 audit. That's too far out. So it will just depend on the time frame and also your auditor as well, and what their processes are and what they will accept, and talk to them and see what their checklist is. So I hope that answers your question. There's no blanket, one size fits all for that. Every auditor will be different. You get 10 auditors in a room, you're going to get 10 different answers. That's the reality. Okay, let's move on and talk about specific assets. And let's start with unlisted assets, and then we'll move on to business real property. So the ATO expects trustees to consider a number of factors when they're valuing unlisted entities, which includes the value of the assets which is held by the entity, or it could also include the cost of acquiring the units or shares in that year purchase. Now, we know for a fact that nobody's going out to pay for a valuation for one of these unlisted entities, so we've got to have a look at what other options are available. Of course, when we're looking at cost price, as we've said, only in the year that it's purchased, and it will also depend on when they're purchased. So if they're purchased on the 1st of July, for example, It's going to be unreasonable to expect the auditor to accept that as the valuation for the following 30th of June. They may accept it if there's further evidence to support the fact that the valuation hasn't changed, but you have to have that evidence. And we absolutely understand that the biggest issue is where a different accountant is preparing the financials for that unlisted entity, because that makes it impossible to get those signed financial reports sometimes. And as we know, it's only super funds that are required to value their assets at market value. So there's all these issues which continue to make everyone's life difficult. It's like pulling teeth without anesthetic. You just go around and round in circles. Sometimes when you can't get that information, it's just better to call it and go back to your auditor and say, hey, we've got no more information. We're just wasting time. Just finish the audit on what you've got, if in fact you know that there's nothing else coming. It also means that while there's not a lot we can do about it, it means that trustees need to be thinking a little bit more carefully about what their responsibilities and obligations are for the audit when they're acquiring, or even before they're acquiring that asset, and make sure that they can manage that property. So what we want to work out is what other types of audit evidence will be acceptable. Now, the first one, as we've said, independent expert valuation of the entity. We're never going to get that. The other types of things the ATO expects trustees to do is get a value of the assets in the entity. So if there's a property in the entity, get a valuation if it's the only entity. If there's several properties in there, you can get those independent qualified property valuations, or you can get valuations from a real estate agent, as long as the methodology has been mentioned, and depending on, let's assume it's comparable sales, those comparable sales then get attached to that particular valuation report. But if you've got all that in line, the auditor is going to be very happy, and you'll probably get a green tick. Where there's been a recent sale or purchase of shares or units, and it has to be between unrelated parties, then that value can be used to work out what the market value of the entity is. And when we say recent, it would have to be, I guess, within 6 months at the most of balance date for it to be considered to be recent. Once again, that's going to be up to your auditor. There could be a share registry provided, or an investor report that will substantiate the value, as long as with the investor reports, it's obviously 30th of June and not, halfway through the year at December. We can also accept an email from a CFO or a director. Now, both of these have to be unrelated parties. It also needs to contain the price, and also the rationale or the methodology for how that price was calculated, which could easily be a recent sale between unrelated parties. We can also get the value from annual reports of those investor reports, but as we said, dated at June 30. When we're looking at the NTA, that's only going to be acceptable if the entity values the assets at market or fair value. And we're going to be looking at the notes to the accounts and see what the valuation policy is to determine whether that calculation would be acceptable or not. And as we know, in most cases, it's not. Also remember that your auditor is also going to ask for signed financials for these entities, but that's unlikely to be sufficient evidence on its own. The primary reason, or one of them, is where the auditor wants to ensure that that entity is a going concern, especially if that investment is material, because that can have an effect and an impact on the ability of the fund to be a going concern, especially if it's in pension phase and relying on liquidity to be able to support and pay for that pension. Okay, got another question here from Hilda. Thank you, Hilda. My fund has a house in the USA. Is it acceptable a CMR? I'm not sure what a CMR is from the real estate in the city of location. I'm assuming that's some sort of current market report. If I'm wrong, please, market valuation, current market report in the city of location. It will depend. Like, second time, it's going to depend. As we've said, everything has to have that objective and supportable data. So when in Australia, when we got those curbside valuations from real estate agents, which just said, I've had a look and I've looked at comparable sales and the house is worth $400,000, sign Joe Blogs. And that was accepted many, many years ago. it's no longer accepted, because what they will expect, auditors will expect to see, is what that comparable sales are. They will make sure that that valuation has been calculated correctly from those comparable sales, and they will make sure that they're able to, say that that's a fair market value. So it will depend on the evidence that's coming through, whether the methodology is stated and whether there's evidence which supports that methodology that the auditor can see. The auditor is not a valuation expert. They've just got to look at the evidence that you're provided and say, yes, that looks fair and reasonable based on what you've provided to me. So the answer is going to be, it depends. If you've got a fairly, and some reports are fairly comprehensive and good quality, but it will just depend on what's going to be coming through as to whether it's not a blanket. Unfortunately, without seeing what you're talking about, it's not a blanket yes or no. So I'm sorry about that, Hilda, but it is a bit of it depends. But hopefully it's given you a little bit of idea to think about what you actually need for objective and supportable data. And when you see that come through from the real estate agent, that you can go back to them and say, I need more meat in the sandwich because my auditor's not going to accept that. Okay, let's just have a little bit of a pause and let's ask a question about whether you think this is objective and supportable data that could be used at audit. Now, this is a real audit question that went out to a client. Obviously, the names have been changed to protect the innocent. The auditor asked the accountant for evidence to confirm the value of the units in the Kath and Kell Unit Trust. And the answer they got back was, I checked with the accountant who prepares the financial statements and it didn't get updated because last year's value was still valid. So with everything that we've been through, what do we think about that? Is that okay? Well, the answer is a big no. And unfortunately, as we've said before, the process is like pulling teeth without anesthetic, but compliance is compliance. And the correct evidence that's needed, all of which we've gone through, is required to substantiate the value. So that is going to be an issue at audit. It's going to hold up the audit, and the query circle is just going to keep continuing until you come back with something that's more tangible. So the question is, how are you going to document the evidence for unlisted entities? Now, this is just a suggestion that I've put on paper for you. It's not cast in stone. You can take this, you can run with it, you can flex it out however you want. But it is a bit of a roadmap to help you sort of put something together that you could use to prepare a market value minute. First off, it's a minute that gets addressed to the auditors. It contains an opening statement that provides an overview of what the investment is, how many shares or units there are, and what the market value is worth. Then you can list the objective and supportable data in the minute. So that makes it easy for everyone, because that gives you and the auditor a frame of reference that provides that evidence of what the value is and how the trustee arrived at that value. Now, the minute itself isn't enough. You have to attach that evidence that you're citing to that particular minute, depending on what it is. So you could use an independent valuation or a property valuation. You could also use the income yield approach, and to document that, you would have a statement saying that the fund received X dollars during the year, which resulted in a yield of X percent, and that gave us an estimated value of X dollars. You need to make sure, though, that, as we've said, whatever evidence you're citing is attached to the minute. You can actually include a final motherhood statement that basically says how that valuation process has been undertaken, which is basically regurgitating the definition of market value in section 10.1, right? But it says it's used as a rational and reasoned process. It can be explained to a third party, and so on. So you're basically just paraphrasing the ATO's valuation guidelines in that summary, however you want. But then what you've got is you've got a document that can be provided not only to your auditor with the evidence attached, but also to the ATO if there's ever a question on how the valuation was determined. So putting that minute together, attaching the objective and supported data means that, yes, you're increasing your documentation, but you're cutting also down on the number of audit queries you're going to get, and you're going to hopefully get on top of an ATO review very quickly. Hopefully that'll work for you. As I said, you can flex that however you like. change it up. It's not anything that's cast in stone. It's just a suggestion, but it gives you something which is more tangible than having nothing, and a process that you can start with. Okay, let's move on to business real property, because this one can have a lot of repercussions, especially where it's been acquired from a related party in terms of Section 66 breach and our old friend Gnarly. Now, if we look at what constitutes primary evidence here, you can go straight to audit because you've obviously got that qualified independent valuation. And remember the ATO's opinion on getting an independent market valuation where the property represents a significant portion of the fund's value. It might be complex, it could be a property development, and so on. Now, as I've said, not a requirement of the auditing standards or SIS, but once again, I think the ATO is just trying to make sure that the trustees are doing their job at putting assets at market value correctly, and it's just not a guesstimate. Question is, though, if you get an independent valuation done in year one, will that be enough to support the value in year two? Hey, we've got an it depends answer, because you've got to provide that objective and supportable data to prove the market valuation every year. So if you've got evidence to show that there's not been a change since the last year, then that's going to be accepted. It would be hard to think about any sort of property that didn't change even by CPI, especially if it's business real property over the year. But you need the evidence. You just can't write that minute saying, I've looked online, nothing's changed and we're good to go, because that's not going to be accepted. What about other evidence? What else could you use there? Well, what the ATO says is that it's not generally sufficient to have just one item of evidence. Now, this is the ATO saying this isn't me. They've got a whole list of evidence of which all this is included in, and it says if you're going to go down this path, you have to use 2 items of evidence to substantiate market value. So you can have a look at QC 26343 and see what the ATO says. Not part of the auditing standards, not part of Reg 8.02b. Each auditor is going to look at the evidence provided and make their own judgment, so talk to your auditor. And in fact, I've had a discussion with an auditor that they don't agree with the ATO's guidelines in this area, and they're just happy to take the one piece of evidence and have the discussion with the ATO if it comes to that. Now, interesting stance, but, you know, are you going to win that argument against the ATO? I don't want to be in that firing line. So let's go through it. Where we've got that market valuation or appraisal by a real estate agent or a registered valuer, need to see the evidence of the methodology. So if they say it's based on comparable sales, give us the comparable sales. The trustee can source those comparable sales and provide that as evidence, but the auditor is going to check it to make sure the value is correct and it's based on those comparable sales. And when we're talking about comparable sales, we need to talk about apples and apples. We're not using the sales of a 2-room office against a warehouse, for example. Sales price for the year the property was purchased will also be acceptable, once again, depending on when it was purchased. So any more than 3 to 6 months, I think you're going to have questions from your auditor. Check with them. They will let you know what their expectations are. Rates notices are only acceptable for vacant land. So we know that vacant land can be business real property if it satisfies the business use test, but unless it's vacant land, which is using the rates notice, it's not going to be acceptable for any other type of property. Capitalisation of net income can be used, of course, if it's a related party tenant, then you need that rental valuation on file to ensure that the calculation is at market value. And similar to the minute for unlisted shares, you can say, have that motherhood statement that says the fund received X dollars, which represents a yield of X% and results in a valuation of X dollars. Now, online commercial property reports are now a new breed of service providers. They compile what I sort of call a bit of a hybrid report, and it's typically done by a company with valuation experience in property or their registered values, but it's more than just that algorithm from comparable sales that we see for residential property. We get information about the property, it's got income potential, rental yields, comparable sales. So it definitely provides the methodology used to come up with a price. The good thing about them is that they're not as expensive as a qualified independent valuation. There is a cost involved. I think they start at $270, they go up to $800, depending on who you use, but they do provide retrospective valuations, which can be important if the fund's got outstanding returns. And the last one is for commercial reports for commercial property in the area. That can give you an estimate of what's happened in terms of growth, property trends and income yields, and rental yields. But once again, make sure you're comparing apples to apples and not apples to oranges here. Use it with care, because these types of reports are based on median prices, which can be distorted, as we know, by those high and low values. And it may be, a movement in value which doesn't relate to the property. And so they're not specifically a valuation tool, but they could be used with other types of evidence. I'll just touch quickly on farmland, because that's always really difficult. You've got to be careful, because often there's no comparable sales. It's difficult to get information, but there is a really good report put out by Bendigo Bank called Australian Farmland Values, which provides a report for every state and territory. It's based off of farm sales information from Pricefinder, and it uses those total sales price, which can include value of capital improvements, which is good. It breaks down each state into regions. It gives an overview of what's happening in each region. It gives median prices by parcel size and municipality. So there may not be a lot to use, but at least you can start using the Farmland Values Report from Bendigo Bank. That's a starting point, in conjunction with one of those other valuation methodologies that's up on the screen, in line with ATO guidelines. Okay, how are we going to document the evidence for this? Same as the unlisted entities. We get the minute happening. We've got our opening statement. The property's here. It's worth this. And once again, suggestion only. You can tweak this however you want. Prepare it, address it to the auditors. Then you list all your objective and supportable data. Make sure that it's attached. If you don't have that independent qualified valuation, be aware that the ATO wants you to use at least 2 types of evidence from the list we just went through. And once again, finish off your motherhood statement that aligns with the definition of market valuation. I can see there's a question come through from Lucas. Sorry, I'll go back up. Hilda's asking another question. What would be the situation for a listed share like Rex Airlines, purchased listed in the ASX? Today it's in administration. It was unlisted in the ASX at 30th of the 6th, 25. It was still in administration, listed in the ASX. Yep, you're in a wait and see. Unfortunately, I don't know what all the ins and outs of Rex Airlines is, apart from it being a very sad story, of course. But you need to wait until administration's is finished. Obviously, you're getting letters. It will tell you whether you're going to get any dividends or what the final outcome might well be. Until it's all finalised, you're still in a holding pattern, as far as I'm aware. So I'm not aware of all of these particular circumstances of that delisted. But while they're delisted, you can't get rid of them to a related party, because they're not listed shares. So you're going to have to sit and wait, or at the end potentially just write them off. It's going to be a wait and see. Luca, thank you for your question. I saw a case of a fund lodging a tax return in May of the following year, following 30th of the 6th. The real property was valued by a real estate agent as that May. What was that valuation acceptable? So they lodged the tax return in May of the year following 30th of June, and the property was valued by a real estate agent in May at the time it was actually lodged. Well, I wouldn't have accepted that. I don't think that an auditor should be accepting a valuation which is effectively 11 months later for the previous year. That's not market value, unless there was some other documentation that was there on the 30th of June of the previous year, which I don't have all that information for. There might be some other information, but certainly you can't piggyback your valuations in May to go for the previous year and the current year. It doesn't work that way, because remember, a lot can happen within that 11 months, and it's not market value as at that day before. Okay, let's just have a very quick look at a case study. It's a Kath and Kell super fund. They want to acquire farmland into the fund from a related party. Kimmy, their daughter, is a licensed real estate agent. She's got a lot of experience putting together valuations, because that's where she works. She's prepared the valuation. She's based it on comparable sales, acreage, the economy, performance. She's done a pretty good job. And the value's 420, that's a typo. It should be 420,000. Sorry, those figures are the wrong way around. I beg your pardon. That's a typo. The value is 420,000 based on the average of the comparable sales. But she's listed 4 properties, but she's only used comparable sales calculation for 3 of them. The final value should have been 480,000, but Kimmy got a little bit excited and stuffed it up. So what's the auditor going to say? Well, the auditor's going to check the calculations because it's used the average of those comparable sales listed in the valuation, bar 1. So the first few issues is Kim's a related party. She's not independent, even though she's professional. The valuation's not based on all the comparable sales. Unfortunately, Kath and Kel have already acquired the property at 420. The horse is bolted out of that compliance corral. You can't put it back. So you've got a massive compliance breach, which is the funds acquired business real property from a related party, not at market value. You've got a Section 66 breach, and you've got gnarly. So you're going to have capital gains tax on disposal at 45%, but plus also any income received in the interim. So be very careful with the valuations that you're using, especially when it's from a related party and there's these high-risk transactions going on. It has to, as we said, has to be disposed of. You've got that, triggered that gnarly provisions. So without getting that professional advice in the first place from an independent party, this has ended up biting Kath and Kel and obviously being a loss leader for the fund. Just some key takeaways. We're just right on time. So please understand the market valuation requirements under SIS rules and the ATO guidelines. Check with your auditor, see what evidence they want. What do they expect for each asset class? Educate your trustees, give them your auditor's checklist, see what they need to provide annually for those complex assets. Don't forget about gnarly when acquiring assets from a related party. In fact, I would be putting the gnarly lens on all fund transactions to do with property because the ATO is going to go spare in this area. Don't panic about Div 296. There's still plenty of time. There's no need to fire sale assets at this stage. It's still not law. So I have gone 1 minute over. Apologies for that. Brings us to the end of the session. I'm still happy to stay online and take questions. So please don't hesitate to put them online. And I guess the final takeaway here, is to just make sure that you document everything. And remember, if the fund did it, the file should show it. And if you follow that logic, you're going to make your auditor and the ATO and your trustee clients very happy. Thanks very much. Back to you, Teddy.
No worries. Anyone have any other question? Doesn't look like they have any question. If you want to ask Shelley directly, you can raise your hand and Henry will unmute you so you can ask directly. Just following up the question from Shelley, what happened if the super fund, say the super fund has a lot of return for the last 2 years and now they want a lot of return this year? Obviously, they have to get a valuation for the last 2 years. So then obviously the report has to be prepared now. Will that be acceptable or?
Well, at some point in the past, they would have got a valuation or it would have been bought at cost or something like that. If you're talking about 2 years, that's outstanding and they're getting an independent valuation in the current year, they could potentially just use the incremental approach for the last 2 years, or if they want more certainty or their auditor's not happy to accept that, they might want to go back and do one of those retrospective hybrid reports, which is available because they do go back in time, and which is good because that if you're using a core logic report, it's only the here and now that you actually get that valuation, whereas going to one of those hybrid reports, it's going to be a cost there, but certainly the cost is potentially going to be worth it to not have the ATO put their magnifying glass on the fund. So it's going, once again, it'll depend on the auditor. But I mean, and if it's 2 years back, depends on what valuation they got 2 years ago, what's happened in the market. They need to do a little bit of homework, but it may well be that the auditor, for 1 year, I would have thought they might have accepted the incremental approach. 2 years, it might be pushing it a bit. You'll need to talk to the auditor.
Okay.
There's no other questions.
Okay, no other questions. So,
Either
Okay.
done a really good job or a really bad job.
one or the other.
One or the other. No in between.
Okay, so if there's no other question, we'll probably there's no other question there. Okay, so thank you, Shirley, for sharing your time, expertise, and insight with us this afternoon. Your valuable contribution has given us plenty to think about as we continue to navigate the evolving superannuation landscape. So, to everyone who joined today's session, thank you for your participation and also your continued support. If you'd like to learn more or have specific question, you can reach out to Shelley directly. The contact number is on the screen. And I'm sure she'll always be very happy to assist you and your client further. So, as this is our last formal session for 2025, I would like to take this opportunity to wish you all a very Merry Christmas and a Happy New Year. And we look forward to seeing you again in February 2026. And hopefully, we'll be back at CP office. And also, obviously, we can continue with a hybrid session. And until then, stay well and stay informed and stay connected. So thanks again, Shelley, for
Thank
a
you.
fantastic session. Thanks.
Thanks, everybody.